Hello guys, today we will discuss about APT or Arbitrage Pricing Theory. Let's start. Arbitrage Pricing Theory or APT. The pricing of asset is a topic discussed across financial and asset management. In financial management, a firm wants to know the cost of capital and the return required before investing in a long-term investment project. In portfolio management, a key input in portfolio construction is the expected return for an asset. Asset pricing model describes the relationship between the risk of and the expected return. The two most well-known equilibrium pricing models are the capital asset pricing model developed in the 1960s and the arbitrage pricing theory model developed in the mid until 1970s. And the alternative to the equilibrium is arbitrage pricing theory, an asset pricing model based purely on arbitrage argument was derived by Roos, 1976. Arbitrage pricing theory or APT model postulates that an asset expected return is influenced by a variety of risk factors, as opposite to just market risk as suggested by CAPM. Arbitrage principle 1. One price. A given asset must have the same price. 2. Multi-index model requires the return on any stock be linearly related to a set of indexes. 3. Short selling. Arbitrage is the simultaneous buying and selling of an asset at two different prices in two different markets. 4. Less restructured assumption. The expected return on a security or a portfolio is influenced by several factors.
For example, the three assets A, B, and C can be purchased today at the prices shown below, and can it produce only one of two payoff? If we solve for the weights for A and B, which would simultaneously satisfy the previous equation, we would find that the portfolio should have 40% in asset A and 80% in asset B. Suppose that $1 million is invested to create the portfolio with asset A and B. The $1 million is obtained by selling short asset C. The proceeds from the short sale of asset C provide the funds to purchase asset A and B. Thus, there would be no cash outlay by the investor. The payoff for step 1 and 2 are shown in the table. So, the APT model formulation can be represented at this slide.
Supporters of the APT model argue that it has several major advantages over the CAPM or multi-factor CAPM. First, it makes less restrictive assumptions about investor preference toward a risk and return. The CAPM theory assumes investor trade-off between risk and return solely on the basis of the expected returns and standard deviations of prospective investment. The APT model, in contrast, simply requires some rather unobtrusive bounds be placed on potential investor utility functions. Second, no assumptions are made about the distribution of asset returns. Finally, since the APT model does not rely on the identification of the true market portfolio, the theory is potentially testable. Summary: the arbitrage pricing theory is developed purely from arbitrage arguments. It postulates that the expected return on a security or portfolio is influenced by several factors. Proponents on the APT model cite its less restrictive assumption as a feature that make it more appealing than the CAPM. Moreover, testing the APT model does not require identification of the true market portfolio. It does, however, require empirical determination of the vector because they are not specified by the theory. Consequently, the APT model replaced the problem of identifying the market portfolio in the CAPM with the problem of choosing and measuring the underlying vectors. General principles of investing. First, investing has two dimensions: risk and return. Second, what is important is how the inclusion of an asset into a portfolio will affect the risk of the portfolio. Third, risk can be divided into two general categories: systematic risk that cannot be eliminated by diversification and unsystematic risk that can be diversified away. Finally, investors should be compensated only for accepting systematic risk. Thus, it is critical in formulating an investment strategy to identify the systematic risk.